Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about SHUANGDENG Group Co. Limited annual report. SHUANGDENG Group Co. Limited is a Chinese company that specializes in providing various businesses and services related to energy storage solutions. At the core of their offerings are lithium-ion battery systems, which cater to different industries such as telecom, IDC, internet data center, and power backup. Their product lineup includes SHVP lithium batteries for IDC, SD8-4000, 850 series lithium iron phosphate battery systems, assemblable batteries SD8-4000, 820, small cell power system 6 kW, small cell power system -2000 and 3000, and air cooling BASS, battery energy storage system. These products are designed to provide reliable backup power for various applications. In addition to lithium-ion battery systems, SHUANGDENG Group also offers lead-acid batteries for communications energy storage solutions. Their products cater to diverse industries such as telecommunications, mobile networks, China Unicom, ships, and railways. Furthermore, their lead-acid batteries are used in backup power supply for power systems, nuclear power plants, UPS uninterruptible power supply, emergency lighting, and other critical applications. Overall, SHUANGDENG Group Co., Limited provides a comprehensive range of energy storage solutions that cater to various industries and applications, making them a reliable partner for businesses seeking efficient and reliable backup power systems. SHUANGDENG Group Co., Limited, market capitalization of $5 billion, is significantly larger than the average industry peer of roughly $0 billion. This shows that SHUANGDENG Group Co., Limited holds a significant advantage in their industry. SHUANGDENG Group Co., Limited trades at a higher price-to-earnings ratio of 15 times and a higher price-to-book ratio of 1.2 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The leverage on the balance sheet appears elevated, with liabilities of 54% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Average liabilities have increased consistently as the company expands. Importantly, both assets and shareholder equity have grown at least 20% faster than liabilities, indicating that the business is expanding substantially and generating value after covering its obligations. Shareholder equity has expanded consistently over the past 5 years, with growth supported by rising operating income. This suggests the company is profitable and financially sustainable. The share count has remained broadly unchanged, indicating no significant dilution or buyback activity over the past 5 years. The income statement shows that the company have been growing its revenue annually, and the operating income have been increasing. This shows that the business model works and the business is expanding. The primary drivers of revenue growth for a company can be attributed to several key factors. One major contributor is the significant increase in demand for lithium-ion battery products, which have seen a year-on-year growth of plus 31.6%. This growth can be attributed to increased production capacity and strengthening development of these batteries for applications such as AIDC smart computing centers. Another driver of revenue growth is the expansion of the company's energy storage business, particularly in the area of power energy storage. The new power energy storage business has seen a remarkable plus 97.9% year-on-year growth, indicating a strong market demand and potential for future expansion. In addition to these drivers of growth, the AIDC Smart Computing Center energy storage business has also experienced significant growth, with a plus 37% year-on-year increase in revenue. This suggests that the company's focus on energy storage solutions is paying off, particularly in the smart computing sector. On the other hand, there are some areas where the company has seen a decline in revenue. The telecom energy storage business has experienced a minus 18.2% year-on-year decline, indicating a potential shift in market demand or competition from other players. Additionally, the sales of lead-acid battery products have decreased by minus 11.1%, suggesting that this product line may be losing market share to more advanced energy storage solutions. The company's net income experienced a significant decline of approximately 25.3% from RM 100 and 15.6 million in 2024 to RM 86.4 million in 2025. This downturn is attributed to various factors, including adjustments in export tax rebate policies and rising prices of raw materials. Furthermore, the gross profit margin saw a substantial decrease of 16.2%, dropping from 16.7% in 2024 to 14% in 2025. Despite an increase in operating revenue by 13% year-on-year, this growth did not translate into improved net income or profit margins. The adjustments in government incentive policies also played a role in the decline of net income and profit margins. These changes had a ripple effect on the company's financial performance, leading to the observed decrease in profitability. The company's financial performance indicates a strong ability to generate cash from its core operations. According to the provided information, the company has consistently demonstrated positive operating cash flow in recent years. On page 20 of the report, it is stated that the company generated RM 1,043 million in positive operating cash flow. This suggests that the company's business activities are generating sufficient cash to cover its operational expenses and investments. Furthermore, on page 32, the report highlights that the company will continue to generate a significant amount of cash from operating activities in 2025, with an estimated RM 77,303. This reinforces the notion that the company is capable of producing positive operating cash flow. Additionally, on page 56, it is explicitly stated that the company is indeed generating positive operating cash flow. This confirms the previous findings and provides further assurance that the company's financial performance is robust. In conclusion, based on the provided information, it is clear that the company is generating positive operating cash flow, which is a key indicator of its financial health and stability. The company's debt level has experienced a slight increase over the past year. According to the extracted summaries, the total debt level rose by 1.4% from RMB 900 and 28.7 million to RMB 900 and 42.8 million. However, it is worth noting that while total bank borrowings guaranteed by the company decreased, other types of debt increased. In terms of interest expenses, there are indications of an increase. The summary suggests that the rise in current liabilities and interest-bearing bank and other borrowings may have contributed to higher interest expenses. Specifically, the interest expense on financial liabilities not at fair value through profit or loss increased from RMB 19,842 to RMB 27,951. This represents a significant increase of RM 81.9. The company's performance varied across different segments and regions. On the positive side, the domestic market, power energy storage business, high-growth regions in new energy, and the Chinese mainland all showed strong results. These areas contributed significantly to the company's overall growth. However, there were also some underperforming regions. The overseas markets, particularly Europe, Southeast Asia, and South Asia, struggled to keep pace with the domestic market. This trend was consistent across multiple reports, indicating a need for improvement in these regions. There is no significant activity to report on acquisitions and divestitures. The company has not made any notable purchases or sales of assets, businesses, or subsidiaries during the period under review. This suggests a stable and conservative approach to growth and expansion. Concerns about inventory buildup are valid based on recent data. A significant increase in various types of inventories has been observed across different stages of production and distribution. The raw materials inventory has seen a substantial jump of 62.7%, indicating that companies may be stockpiling essential components to meet future demand or mitigate potential supply chain disruptions. The work-in-progress inventory has also increased by 36.2%, suggesting that manufacturers are producing more goods than usual, which could lead to an accumulation of unfinished products. Furthermore, the finished goods inventory has seen a notable rise of 58.8%, implying that companies may be holding onto completed products for longer periods or experiencing difficulties in selling them off quickly. The increase in goods in transit by 28.6% also raises concerns about potential bottlenecks in the supply chain, where products are stuck in transit and not being delivered to customers on time. These inventory buildup trends suggest that companies may be facing challenges in managing their supply chains effectively, which could have long-term implications for their operations and profitability. That concludes the financial summary for SHUANGDENG Group Co. Limited. Feel free to comment below, and I will be happy to answer them when possible.